Hello friends, Namaste and welcome all of you to my channel. Today I will be discussing about your additional fund needed. How could we estimate or the project the additional fund needed for our company? Before moving to this topic, let's discuss about why we need the additional fund needed. We all know that the market is so competitive. If our products demand in the market is high, then we try to expand our business, and for which we need to invest in the assets. And when we need the funds to invest in the assets, and that will be sourced from debt and equity part, okay? That is your source of finance. That is why we say that projecting the financial requirements or additional fund needed is all about your projecting the quantum of finance, what amount of money that your company needed to meet the investment in the assets, okay? Now let's discuss about your, particularly I will be discussing about your additional fund needed. When we say additional fund needed, it includes your three methods. One is called your percentage of sales method. Next one is called capacity adjustment. Third one is called your regression approach. Today I will be focusing on the one approach that is called percentage of sales method or approach, under which you could see there is the two. One is the projected financial statement method. When we say financial statements, it includes your like income statement, balance sheet, statement of return earning, and your fourth one is your statement of the cash flow statement. Projection is all about it. We try to project for or estimate for the coming futures. Okay. Now, assessing your overall financial your requirements. Now, second one is the formula approach, and under formula approach, I will be discussing that is all about how we estimate your additional fund needed by using the equation. Okay. Now next one is that your let's discuss about your additional fund needed formula or equation. Then you could see that is your external fund needed, as I explained earlier. That could be your source either by borrowing or selling the new common stock. Borrowing is all about your debt, and the selling is all about your company is your, let's say, the public limited company listed in the stock exchange. Like in case of Nepal, like your Nepal Stock Exchange, in India, Bombay Stock Exchange, New York Stock Exchange in the US context. Okay, each country has so many stock exchanges may be there. Now, it depends on your all about your what sources of finance you are going to use. Before that, we have to estimate your additional fund needed. That is, you can see that is your total is your total fund needed minus funds available internally. That's your additions to return earning. Now, important point is that when you are using the AFN equation or the formula approach, then A asterisk notation you need to understand, that is your A asterisk is all about if you would like to increase your sales by 20%, then you have to invest 20% in your assets also. That is called assets which are proportional to sales. S0 is the current sales, and this is nothing. S1 minus S0 is the change in sales. Okay, you say the delta S, you can use it. L asterisk is all about your spontaneous liabilities. All liabilities will not change proportionately. Only spontaneous liabilities, which include your accounts payable and the accrual parts. And B is called the your retention ratio. If we let's see the 20% is the dividend payout ratio, then 80% would be the retention ratio. We say C is your profit margin ratio. S1 is the expected sales. Now, important point is that if the company has the more additions to return earning these parts, then your additional fund needed will be lower. Okay, that is why we are saying we say that additional fund needed will decline because of your increase in additional fund needed or internally generated funds. Okay, now look at this example. We have a balance sheet is there, and the total assets we have a 1000, which includes the cash and securities, account receivable, inventories, net fixed assets, total assets. While under the claims, or you can say that debt and equity, or that's your accounts payable, accruals, notes payable is there. That's the total current liabilities. CL is the current liabilities, which is also called the short-term liabilities part. While long-term debt is there, common stock, return earning is there. But this is about your last year, 2020. Then we have again the income statement is there. That is your sales, cost, your earning before interest and tax. You deduct your interest. EBT is there. Anyway, that's your 2020 figure. Okay. Now assumption is that the company is operating at a full capacity. Each assets your grows proportionately with the sales, and the spontaneous liability that includes your payable and accruals grow proportionately with the sales. Profit margin is 2.52. Payout ratio is 30%, while sales increment is the 25 percentage, or that's increased by 500 million. Now the question is, based on this given information, how could we estimate the additional fund needed? Simply we use this equation as I explained earlier. Now we have a asterisk is we have value is this one 1000 divided by current sales. S0 is your 2000. Okay. Now change in sales is your expected sales is 2000, is your S0 is 2000, S1 is 2500 because your sales increased by 500. So S1 minus S0 change in sales would be the just 500. Then you L asterisk is your 100 we have. This is given is the 100. Then you simply again divide by current sales. Now as I explained earlier, that's your we have a dividend payout ratio is 30%. Dividend payout ratio is all about your 30% of the profit will be distributed to the shareholder. It means the 70% would be retained in the company for the future reinvestment purpose. That is the concept. Okay. Now C is there. Now we came to know that our additional fund needed for a company is the 180.9 million. Okay. Now this additional fund needed would be financed either by using the debt and equity, and that will be the based on your risk taking behavior, and that is all about your capital structure decision. If you are using the more debt, there will be tax saving, no doubt, but the condition is that if you are not able to manage the debt properly, you would have your financial issues also and the bankruptcy situation also. Okay guys, these are the basic content that I would like to share today. If you like this content, please like, subscribe, and share this channel. Thank you all of you.